Millions of everyday people are quietly building wealth while doing almost nothing. And the secret isn't some hedge fund algorithm or a hot stock tip from your brother-in-law. It's one of the most boring, beautiful financial tools ever created. And there's a good chance you're sleeping on it right now. We're talking about index funds, the financial equivalent of betting on the entire casino instead of one table. And historically, the casino always wins. The S&P 500, for example, has returned an average of roughly 10% annually over the last century, which means a single, boring, automated investment has quietly outpaced the vast majority of Wall Street's best-paid professionals. Now let's back up and ask the real question. Why does something so simple work so well when thousands of brilliant, overpaid analysts with Bloomberg terminals and custom Excel macros can't beat it? The answer is almost insultingly straightforward. Most active fund managers are charging you high fees to underperform the market, and the data has proven this so consistently, it borders on financial comedy. Think of it this way. An index fund is like ordering the entire menu at a restaurant instead of gambling on one dish the waiter swears is amazing tonight. You get a little of everything, and while some dishes disappoint, the overall meal is almost always satisfying over time. The S&P 500 alone holds 500 of America's largest companies. So when you buy into an index fund tracking it, you own a sliver of Apple, Microsoft, Amazon, and 497 of their closest friends. That kind of diversification used to require enormous wealth and a team of advisors, but now you can access it for an expense ratio as low as 3 basis points. That's 0.03% for those keeping score at home. Here's where people get tripped up though. They assume passive means inferior, like driving a minivan instead of a sports car. But the irony is that the minivan, in this case, keeps passing the sports cars broken down on the side of the road because the driver got too clever. Dalbar, a financial research firm, has studied investor behavior for decades and found that the average investor dramatically underperforms the very funds they invest in because we panic sell at the bottom and chase returns at the top like it's a national sport. Index funds don't panic, they just hold, rebalance, and grind forward with the quiet confidence of someone who has read every book in the library and gone to bed at 9 p.m. There's a persistent myth that you need to time the market or find the next big winner to build real wealth. And this myth has cost ordinary people more money than any market crash in history. The truth is that time in the market almost always beats timing the market. And even a caveman dollar-cost averaging into a total market index fund from 1985 would be embarrassingly wealthy today. Let's talk about fees for a second, because this is where the absurdity really reveals itself. Some actively managed funds charge upward of 1% or even 2% annually, which sounds trivial until you realize that over 30 years, that fee difference can consume hundreds of thousands of dollars in compounded returns that should have been yours. Jack Bogle, the founder of Vanguard and the patron saint of boring investing, once said that in investing, you get what you don't pay for, and that single idea is worth more than most MBA programs. He built an entire company on the radical notion that helping everyday investors keep more of their own money was, in fact, a good idea. And the financial industry never quite forgave him for it. The practical lesson here is almost frustratingly simple. Pick a broad market index fund with low fees, contribute consistently regardless of what the market is doing, and resist every urge to do something clever. Discipline beats genius in this game. Position size and consistency matter more than conviction. And the investor who is boring on purpose almost always outlasts the one chasing excitement. We've seen this cycle play out over and over. Bull markets breed overconfidence, corrections breed panic, and somewhere in the middle, the steady index fund investor is just quietly watching their account grow while everyone else is refreshing financial Twitter. The pattern is as predictable as it is ignored, and every generation seems to need to learn it the hard way. Here's your philosophical takeaway. Wealth building isn't about being the smartest person in the room. It's about being the most consistent one. You don't need to predict the future, you just need to show up, stay invested, and let compound interest do the heavy lifting like the silent, tireless partner it is. Whether markets go up next year, stumble, or do something completely unexpected, the index fund investor sleeps well because their strategy doesn't depend on being right about any particular outcome. That comfort isn't apathy, it's the earned confidence of someone who has built a rational, repeatable process and trusts it more than they trust the noise. And if you're ready to stop watching from the sidelines and start building real, long-term wealth, whether through smart investing, real estate, or connecting with the right lenders, check out our links in the description below, because we can help you take that first step.